All right, my dudes, we're going live here in a second, getting the last few things put together. Wonderful Friday. Make sure everybody knows that we're going to be in. My dudes, welcome. BitsBeTrippin here. Welcome to the live stream. We're going to be covering some things related to market and buying and trading and all the fun things that are like that. And it's going to be totally different than any of your trader bros that you guys follow. We're going to be going through the basics of what it is. And this, when we start looking for categories to do live streams on, I tried throughout the week to identify things if I ever catch myself trying to explain something to somebody or add more clarity, especially that, you know, the market is really growing right now. Bitcoin's at 68 and pushing today. And a lot of folks reach out and say, hey, I want to do some buying. How do I do that? And I've noticed just from friends, family, folks that are in this, are trying to get into it, you know, download maybe Coinbase or going out and get a crypto.com account or a Binance account. And they're just, you know, it's something new to them. And what I want to make this video is, this is really for folks that are new and kind of like how to start to get into like maybe a regular buy, or, you know, if they're going to try to hold some coin. This first part is going to be just purely on the trade aspects. And I'm on the lavender mic today, the lapel rather, because we're probably going to use the whiteboard behind us. I'll switch back and forth between camera and whiteboard to get you guys some just kind of concepts and drawings on how it kind of works. Because if you're just taking spot price, if you log into your Coinbase account and you make a buy, you'll see that the taker fee, essentially Coinbase's fee, and I'm gonna pick on Coinbase for most of this. The Coinbase fee is pretty high. And like, we're buying $100 worth, and I'll look right now and see what the taker fee is on Coinbase. But if I log into Coinbase right now and try to do like $100 buy, just from basic spot, it's going to cost like $10 or close to it, like $8.50. And that's a high fee, and it goes up proportional to what you're buying. And where that comes from is called a taker fee. And we're going to kind of discuss, you know, the difference between takers and then being a market maker. And we do have essentially an outline written up. We have a newsletter and a blog that will include this with a lot of the finer details of that. And I've done it in a way with writing it out as an analogy. So there's going to be some, when you go to click that link, we'll have it in the description after this video. Since we're multi-streaming to all of the different sources, I can't include like descriptions. I haven't actually figured out how to do that without it overwriting. So we'll have in the description below from the different stream sources just an explainer. So anything you're listening from me on this, you'll be able to go there and, you know, read through it with the analogy of all of these different things. We'll talk about slippage, like market slippage, market depth, why that matters, all of these kind of critical things that if you're just getting in to purchase any kind of cryptocurrency, this really applies also to like markets in general, like if you're doing stocks, but is a little more transparent on some of the market exchanges. Like if you're looking at Binance, you know, Coinbase, any of these other exchange, you know, areas, and why like you have different interfaces. Like if you log into Coinbase, let's say you download Coinbase, you log in, you go to do a buy, they try to make it very simple. Buy, sell, add your account, what's your funding source. So you're going to come from like a checkings account. And then, you know, if that's through a debit or an ACH, which is just putting in like your account number and your routing number for them to be able to get the money from your bank account. They make it simple, but when they're doing that and you're buying straight from spot, you're essentially taking. You're taking the price as it is, and there's higher fees. Then you have the maker side of that, was where you become a market maker, and I'm kind of getting right into it, is where you have liquidity. You've moved money in, so you transfer money into your account, and you're like, I don't like the price at 68 today. If you're a buyer, you're like, I'm buying, I'm FOMOing, I'm fear of missing out, I'm buying whatever it is right now. I feel like it's going to push up. But like everybody tells everybody that's been in this space, is you got to zoom out and look at the volatility in Bitcoin. Look at the volatility in these different cryptocurrencies. And what you can do is say, hey, why it's pushing up to a daily high today, like it's pushing into the 68, it may pull back some. So you're like, I'm going to move some money in. Maybe it's $500, maybe it's $100, and you're going to go, I do not like it at 68, but I do like it at 67 or 66. And you could put different levels in there and become a market maker. So you're adding liquidity to the system. You're taking the cash that you have, the fiat, and you are creating a floor for yourself of what you're going to buy. And when you become a market maker, you are essentially putting cash there and just leaving it posted up, saying, I'm not going to try to buy at 68. I'm going to try to buy at 66, let's say, as an example. Like this morning, yesterday afternoon, we were around 66.9. Right now we're at 68. So that's a $2,000 swing overnight, over the evening and into the morning today, that Bitcoin's moved some pretty decent, 2-3% increase today on the price. So being able to understand that you can go into, like, let's say your app on Coinbase, and you can go to the advanced trade option. This is where those features are at. So essentially you got to move money in, have it into a USD account, and then you can go into that advanced trade section, and then you're placing a limit order. And that's essentially you becoming a market maker. And you don't have to pay some of those higher fees, because the fees on the market maker side are cheaper, and save some of that for yourself. So as we get through this today, I'm going to go through kind of essentially the outline that I have, that you guys will be able to click below and see on the description, is essentially the market maker and takers and fees. I'm going to go through a very basic analogy for each of those. Then there's market slippage. And that is essentially like, based on a particular set of volume. You'll see this on like CoinMarketCap's website, of what's the 2%, 3% slip, how much volume sets within there to show, the market price might be 68,000, but if somebody came in there and just did a market sell, there might be only a couple $100,000 of Bitcoin out there, to where if somebody just sold, I'm going to sell $1 million, I'm going to hit sell right now, the slippage of that price could go down 2% on only 200 grand on the whole exchange, right? So there's some risk on you just trying to do a market sell, because you're not getting their spot price at $68,000 for all your volume. If, let's say, you're trying to sell $1 million in Bitcoin, or let's say you're trying to sell 10 grand, like, what's the slippage going to be? Now, this really matters in other coins. Bitcoin's very liquid, meaning there's a lot of capital up and down on that 2%. I mean, the market slippage might be in a couple $1 million in Bitcoin at any point in time, where it's like $2.2 million to move the price. If you're just selling against what the order books are on any particular exchange, you're not going to move the price. If you're doing 10 grand or 5 grand or 2 grand, you're not going to touch the price change. You're talking in tenths of a penny of difference between those different levels. But something, if you're out there and let's say you're spec mining with your GPUs, a smaller coin, a new coin, it's maybe on a DEX, like a decentralized exchange, you got to really look at the market depth, and we'll get into that too. And that's where if you go to try to just dump, let's say you've held Caspa this whole time and you got into Caspa sub 2 cent, and now it's setting at 17, 18 cents. And you're just like, I'm all out. I'm going to sell. I'm going to wait and hold in USDT or something to that effect. If you went and dumped your whole position, you may move the market 10% if you just did a market sell. So you're going to get different levels of sell prices as you go through that. So we'll kind of go through that on the whiteboard of how that kind of mechanically works. And this is really just from a strategy. You don't have to be a day trader. I'm not going to tell you which coins to pick or anything like that. What I'm trying to tell you today in this video is the dynamics at play when you're using an exchange or a market, and trying to understand where you can kind of get your some issues. And there is, like, if the response is good on a video like this and people are happy with, you know, learning more about this, we could expand this into another live stream that would get into like the deck side. If you're talking about bridging and then liquidity pools, like if you're locking up coins on both sides, let's say on the Ethereum network, and you're going to get in, you're going to be full degen, and you're going to try to get into the meme coins, which is beyond doing like casino lottery stuff. But like, there's a lot of understanding of unlocking and locking and those kind of things. We're not going to get into that in this video today. But mechanically, I have a pretty good understanding on how everything works. And to kind of let you guys know, let me know in the comments after this, or in the, you know, the comments on screen, if that's some other you know, deep dive that you guys would like to get into of how all of that kind of works on the decentralized side, and then what are the risks going between layer 1, layer 2s, all those kind of things, because there is some serious nuance with that can burn you hard if you don't understand on how those mechanisms work on the locking and unlocking, and just slippage that comes in from there, especially if you're trying to like pay gas prices and stuff like that on those exchanges. So those are a little different than what we're talking today. I'll also kind of cover down today from an analogy standpoint on short and long positions. There seems to be a lot of confusion of understanding really what's a long and what's a short, how does that mechanically work, and why do people short sell, all that kind of stuff. I'm seeing in the comments wants all the degen info. That's kind of, I think, a good thing. And really, this series, these live streams are on Fridays every week. If you guys put this on your calendar, or if you want to see kind of it later, it's across YouTube, it's across X, and right now I'm live streaming also on Twitch. We are, once we're approved, going to do it through TikTok at the same time too, and Instagram. They have to, like, a Facebook has to approve, Meta has to approve the content for us to do this. I do like the comments. Thanks. I'm doing more content again. Yeah, so we're trying to keep a consistent Friday at noon on various topics. And I do kind of if it's between Ask Me Anything or doing just straight education content in this space with you guys. And you can always add suggestions if you just hit us up on X and say, hey, I really want to know about this subject. We are taking this, you know, you guys in the audience, tell us what you want to hear and see. Some stuff, I live, eat, and breathe this since 2013 pretty heavily. Since 2010, I've been in this space. So I've been around a lot, and most of the aspects that I will talk about is usually typically coming from experience, either failing in it and learning the hard way, or, you know, adjusting things that I have either seen or somebody else showing us how to do online, and then implementing it in some way. So most of the stuff we come through is, you know, talking through our experiences on it. So, and, you know, some of this stuff is just straight mechanical, like what we're talking about today, which is, you know, how an exchange works. The other piece that I want to make sure that we get into is when we start talking about market depth, because it's extremely important, especially on other coins that are not Bitcoin, where the liquidity can really move and shift. And you have those larger market maker discussions, the whales of the world, people that have large positions and can do a lot of interesting tactics, like through what they call essentially in the memory pool, especially on the decentralized side. There's something called the dark forest. The dark forest is just an analogy of some interesting and malicious behavior can happen within the dark forest. If somebody sees, like, if you're putting in, like, let's say a large sell or a large buy, or you're trying to move some kind of, and I mean, on some smaller markets, this could be like 10 grand, where you're presenting it to essentially the memory pool. So you can think of all your orders and trade going into this general transparent area that a whole bunch of people can look, and then they can do something called front run, or they can sandwich attack your trade. And you think everything's going the way it should. you think you have an advantage, and then what ends up happening is somebody in the memory pool is scanning that, and then they create a different or a conflicting buy with a different price and kind of take that liquidity from you, and then they end up liquidating you for way less money that you were expecting. We've done a couple videos on dark forest, but going through that, that's kind of like level 3. So I would look at from a structure standpoint, from just market trading, depth, slippage, long, short stuff is kind of like the beginners, kind of how things work on like centralized exchanges. Then decentralized exchanges would be kind of the second effect there when you're talking about bridging and just the second order effects that can happen on a decentralized ecosystem. And then you get kind of that lower level 3 where you get into like MEV, which is a miner extracted value. So the people processing essentially the transactions from the memory pool, and the templates and the behaviors that can occur within that space can create very interesting market dynamics for anybody that's trying to trade in that space, and to understand on how that functions and work and how to protect yourself of like kind of spreading out your call options and stuff in that environment helps protect like what you're doing from an interest standpoint. Like if you have like maybe an arbitrage opportunity, those kind of things, that's kind of, I would say, kind of level 3 of understanding and mechanics. Usually gets into some kind of scripting or something to that effect. So we're just working on the top level today, which is just how the market works in general and not kind of screw yourself over. And again, for the folks that are just joining, this really came from just talking with friends and just how they are currently buying Bitcoin. Because, I'm not saying everybody's fair weather in this space, but like if you're not full-time Bitcoin crypto, you're tracking it all the time, you're doing your day-to-day, you're just living life, and you're watching it kind of in the outline of like, hey, Bitcoin's doing something. I'm seeing more stuff today about, oh crap, it's up to 68K. Maybe I should buy more. That's the normal mentality, right? From like people that aren't all into this space and doing stuff. And then they'll just go do a market buy on Coinbase, and lo and behold, after you take the fees into account and all that, it might be 68 spot price, but really you're getting it in maybe a little higher than spot, and you have the fees on top of it. Now you're maybe buying at 68.8. You're actually fully realized what you got Bitcoin wise. I'm using Bitcoin as an example here now. You may be like your base spot price is like 69.2. So it's like, well, where'd that $400 go? Depending on what you're buying. So this is really targeting for you folks that are looking to do either dollar cost averaging or anything like that, and then doing advanced trades and becoming a market maker, not a taker. Save fees, get more stats and sats in that way standpoint. So let's get right into the basic analogy from a maker and a taker. And again, I'm reading this from what we have prepared for you guys that are going to be the links below. That way you can kind of just read on your own pace, and just kind of like, sometimes it takes a few times for you to read it and be like, okay, I think I understand what's going on here. And so from an analogy, a maker are like vendors who set up a shop at a market. They create or make an offer to sell or buy an asset that they're willing to wait until somebody else is ready to accept that offer. Because they provide the liquidity, they typically get the lower fees. So when you're a maker is exactly on the market, like if you're looking at your Coinbase app and you're in the advance, you are saying, I'm coming to the table with money and I want Bitcoin, but I'm not paying that price that's current spot. So I'm going to put my liquidity in a buy order somewhere else in the market. And on what you're doing is if you watch any kind of, if you log into it, you'll see kind of like a V structure in that market. And essentially you have your buyers and your sellers on each side. And the volume that stack in that is based on price points. So you can see a market depth in that view that shows kind of where things sit in the stack, like how much depth, how much yield in Bitcoin's standpoint makes up a price scope, right? So if you're talking like right now, you might have 2 Bitcoin sitting at 68.8. You might have another 15 Bitcoin sitting right underneath that from a buyer side at 16.7, because there's more buyers wanting it for 16, make $100 less, or they want to buy it for $100 less. And then somebody might come in there and say, well, I'll buy 20 Bitcoin at, I mean, these are big numbers, right, for Bitcoin, at 67. So you have this depth of field and a volume amount. So then you'll see how big is that order book? What's the float in that? And from like the early days when we used to trade like on Bittrex or Poloniex, if anybody remembers Poloniex, used to have a chat on it, and I miss those days. Those days were great because you could kind of sit there on the exchange and it had a built-in chat interface, and everybody's kind of jumping around the markets and they're just degening the shit out of it and having a good old time just talking about different trades and stuff. But the reality is like, how thin was that market? And you would see opportunities of like, well, wait a minute here, like, there's not a ton of, there might be like, if somebody sold, they could drop the price. There was risk, right? If you had a very thin market on the sell side, meaning on, in Bitcoin, in this standpoint, if there was not many sellers down to, let's say 65, let's say the total market volume on the sell side was maybe 200 Bitcoin. That's a super thin market, meaning if somebody came in there and didn't care about the sell, they just did a market spot sell and just said, I don't care, I'm selling 200 Bitcoin. Fill in whatever the sell orders are, or the buy orders are. You're going to drive that market down. Potentially, if you were buying 200, they're going to get a volume average of buys that are going to level out from like 68 to 65, and they're going to drive that price down. And you'll see that just a strong candle that's like just a solid red, because somebody just went in there and just said, I got to dump these 200 Bitcoin. I'm going to take what I can get. There's buyers that go all the way down to 65 and I can fill my orders. They're going to push that market down. And that's what ends up happening. You end up having these push sells that drive the market down because the market got super thin. If you have a large, sell a large buy wall in there that's going to collapse, not make it drop too far. I like seeing large buy walls. So I'll see somebody comes in here right now. This price is at 68, and if you're looking at that advanced market and you see the price is at 68.8. You might see a large buy order in there for like 1,000 Bitcoin, and that would be like a large wall. And on that V shape inside the market, you're going to see this just tall wall where they're going to have to sell into that. Now, anybody could cancel it, and then that's where you can kind of get trapped, where you're like, well, I'm going to try to buy right behind them. And what they'll do is they'll start selling into that wall, and you'll start seeing the market chew through it. And then they'll pull the order, and then it'll collapse right back into you. Right. But if you're just below it, not a big deal. Same way on the sell side too. So it's a matter of understanding on how each side, if you're a market maker, you're bringing liquidity to the table, and you're most likely putting it at a lower price because you want to buy it lower, right? And that's where your fees. And what I would recommend anybody getting into this space, don't go out there and just buy spot. Go out there and put an order in for a lower price, because Bitcoin and some of these markets are super volatile. So you're going to catch a dip, and you're going to be able to get more yield for your money. On the taker side, analogy for them. Let's go back in the maker and from the analogy. So I kind of set it up from the market vendor side. The analogy is, imagine a lemonade stand where you set the price for a cup at $2. You'll only take money when somebody comes along and agrees to take it at that price. Because you're a maker, you set the price on what you're willing to buy. So you're saying, I'm selling it at $2, and then you can take it from there, right? Takers are like customers who walk up to a market and take that offer that's already there. They accept the maker's price and execute the trade instantly. But they often pay a higher fee for the convenience of not having to wait. So if you're trying to get into that, let's say you're buying something and they only accept Bitcoin, and you're like, shit, I have Tether, I need to go get market right now. I don't have time to put a maker price in there, you just take spot, you are a taker. And for that convenience, the exchanges charge a higher rate because you're essentially taking, instant liquidity off the market and pushing potentially the price down, right? Because you're, depending on how much you're buying, you are forcing the price down because you're taking what's on the market at current spot. So that's what the taker piece is. The analogies, you see somebody selling lemonade for $2 a cup, you're thirsty, so you're going to take that immediately. You're just like, I'm going to take it. Because you're a taker, you're buying at somebody else's price, right? So that's the key piece. As a taker, you're buying at somebody else's price. Now that gets us into liquidity, into slippage. Slippage is what happens when the price you expect to pay or receive changes between the time that you place the order and when the order gets filled. Now this happens in real time. Like if you're not really paying attention to the risk of slip, you like when you go to do it, like the bots, and this is really kind of comes down into the high frequency trading and the bots. And if you're buying just from the interface, the UI in a exchange, you have a potential, and this really comes down on like the taker side. Like, so if I'm just going out there and just trying to buy, I could slip and have to pay higher. Like, so I'm not going to just go be able to buy the market up because I'm going to buy whatever the price I am, and then it's going to run out, and then I'm going to have to spend more to buy more Bitcoin because people are like, I bought up that price point. So now I got to chase it up, right? And you're pushing it up. Both sides, slippage works on both sides, right? So like if you're slipping down, or like if you're trying to buy up, you're pushing the price up, right? And you'll see what's the slippage plus or minus, like on CoinMarketCap as an example. Like how much yield is there before you've pushed like 2%, and you'll see that on like CoinMarketCap is like a 2% slippage. That's what that means. Is what's the depth, what's the yield that is out there that you will spend on, like, let's say $100,000. How much do you move the price? Bittrex was really nice back in the day because Bittrex would show you before you submit the order what you're going to do to the price. And exchanges that do that are awesome. Not like Coinbase, I don't think shows you market depth. I mean, it doesn't show you like what you're going to do with the price on even the advanced side. I think Binance does. I know Bittrex did. So you could say, and I would see this like on Ravencoin as an example. Ravencoin was a very low price, it was in the pennies. You could buy a ton of volume, but there wasn't a ton of volume out there sometimes, and you could really slip the price if you were trying to sell. So let's say Raven was pushing up at the time when Raven went to 24 cents, right? A lot of people were taking profits at 24 cent Raven price. Right now, Raven's like 1 cent 7, right? So let's say Raven pushed up to 4 cents. Well, people might start to sell. If you came in there because you had a lot of Raven that you bought at 1 cent right now because it's cheap, and you're like, well, at 4 cents, I'm going to sell and make a ton. I'm going to make 4x. There's a high chance that depending on what you bought there, which you probably brought some of the price up to that 4 cents, you're not going to be able to sell for 4 cents. There's only so many people buying at 4 cents, and you're going to slip that right back down. So understanding market liquidity and depth is critical if you're going to YOLO into a coin that doesn't have a ton of liquidity. So don't be... and a lot of people will tell me like Caspa and some of these other coins are like, oh my God, look at the price. It's this. It's like, well, what's the market depth? That's the first thing I look at is like, how depth of field is this market and how liquid is it? And what's going to happen if I took a larger position over time and then you try to take a sell position. So, and this is why a lot of folks that are doing much larger volume or trade, they're across all the exchanges and they're doing it through APIs, right? If you start getting into those $100,000s, $1 million, it's worth going into where you can execute trades through APIs to create that, not create a crazy arbitrage on one site. And you would see that sometimes at FTX, and who knows what was going on at FTX. There was a lot of manipulation, let's just say, obviously, that came out from it. But like you had some serious situations sometimes where somebody come in sell the market down to like $20,000 Bitcoin when it was at 70 back in 21. There was, I think, at least 2 times that if you had maker orders at like, let's say, like you could do it right now. You could go on Coinbase Advance. You could put an order out there to buy Bitcoin at $20,000. And if somebody comes out there and it's the market, they're say they're selling 1,000 Bitcoin, and it pushes that price down instantly down to 20K, your order will get filled, or there's a high chance that it'll get filled. And then it'll shoot right back up to whatever price it is, 67 or whatever. And then you log in one day and be like, oh my God, I bought Bitcoin at $20,000. Those are called market flash crashes. And that plays into everything we've just talked about from a maker, taker, and slippage, is like, how far will that slip down if somebody comes in and does a large market sell? Sometimes people fat finger it. Sometimes they have, if they're doing it through scripting, through APIs, they accidentally put an extra 0 on there in their sell. Let's say they're trying to sell 10 Bitcoin, accidentally put 100 in there. And then now they just slip the price 5, 8, 10%. And so if you go out there and create a maker price right now, let's say at Bitcoin at 60, you might get it, because when the market starts seeing a lot of activity like this, some people will take, a sell option and mess it up. And I'm not saying you're checking it. I guess you could hear this, what I'm saying here is saying you're taking advantage of somebody making a mess up, but like the market is the market. Like if somebody comes out there, like that is the due diligence. If you are responsible for selling a large point of coins, make sure you double, triple, quadruple check, have somebody else look at it like before you go to do it. Because like if you do kind of screw that up, there's a high chance the exchange is going to be like, hey, that's just what happened, man. Like, pay attention to what you're doing. The penalty for failure in crypto is pretty rough. So, simple, mistakes. There have been instances where somebody has done it from the miner side and put the miner fee because they're trying to get a fee priority, and they'll kind of fat finger the fee. And that's where you see some of these large blocks where they're like, the reward on Bitcoin 3.125, and you might get a fee that's like 10, and it's like 10 extra Bitcoin on that one block. Was that a mistake, or was that like an ordinal or something, and somebody just really brought the price up because they bought the whole block? But if it's a small transaction moving money and the fee is just excessively high, they could have messed it up. They could have put their priority because they wanted to ensure that transaction would be in the next block. So then they pay a higher fee to make sure that the miners pick it up and include it in the next block. And then that money would then drop in on everybody, kind of like an airdrop. And there's been a couple instances where that's occurred. And then the pool did not release the funds to the miners. They were like, hey, those people messed up, we're going to give that money back. And I know there's been a couple instances of that. I don't remember if it was F2 poll or if it was, I think it was F2 poll that did that. But like there was a couple polls that had that instance where they actually returned the money for the mess up. The miners obviously were like, hey man, like that would have been sweet to have that extra thing. But I think one of them was pretty excessive. It was something stupid like 100 plus Bitcoin. But like that's, again, like that's the mining and then including in a block, but you also have the exchanges that could have, flash crashes. And then if you're a maker on there and you're buying Bitcoin or other crypto, you might be able to take advantage of that. Somebody on the comments, VR computer sounds like a good way to make money. Well, I mean, that's market making. Like if you're out there and you're buying the dips, if you're in a buyer mode, you don't want to FOMO, right? You want to try to catch it on the dips, and you're trying to stack your sats when it's in a lower aspect, right? So there's just not a lot of people that know how to do that. Like they hear about it maybe, but they mechanically don't know how to go in there. And like if you're logged in through your cell phone in the app in Coinbase, you can go right to advanced trade and do these things that we're talking about. But that's so the analogy on that. From the slippage side, I'm jumping back to you on the slippage side. Imagine you're at an auction, placing a bid on a painting, and you raise your hand to bid at 100. But just as you do and you're about to win, somebody else bids 120, and the auctioneer awards the painting to that higher price. That's slippage. I mean, that's the analogy on slippage. It like slips on you. That slippage in the degen world, and I know I said I would have a different video on that, is some of that front running activity could also be seen as that, where it's somebody sees you making a trade because it's all not in a centralized exchange. It's happening on the chain itself using the smart contract architecture that's like, let's say on Ethereum. We used to see this a lot with Ether Delta. If anybody remembers Ether Delta, which was a decentralized exchange, you would see a lot of market orders out there. I think Trade Ogre, there's a couple other large decentralized exchanges, but you would see somebody place an order and then magically it's like somebody else would pick up that order, right? Because people are watching the memory pool, they're watching the execution kick off, and then they're front running you. They're putting a higher priority and a higher fee up front to jump ahead of you. Now it's like real life PvP, right? I look at market trading, and especially in the digital world, it's real life PvP. Like there's just people that are writing scripts and outdoing each other in those payloads to try to get an advantage on them. And you can actually liquidate somebody pretty quick that either have their script wrong or just get murdered on trying to take advantage of like the MEV, the miner extracted value positions. That's why I said so. It's all in video. There is a video I have. If you look up Dark Forest BitsBeTrippin, you'll see a video that we've done on that already. The understanding of this can really, and I'm not, again, this is like do your own research type of stuff. Like I'm not trying to give you any financial advice. I'm just telling you how the machine works, right? On this. So long and short positions. Now there is, I don't think Coinbase allows you to do longs and shorts. I haven't went into their advanced features too much in there. BitMEX did a lot of this. BitMEX Research has a lot of extremely good detail content on all these subjects that I'm talking about. Giving a shout out, none of this is promoted content, just help, where we go and look, and I learn more about this stuff too. BitMEX Research has a ton, but BitMEX allows you to do a lot of this. Before I get into the analogies on long and short, I would just say in the crypto space, especially on the decentralized side, like there's a lot of risk on the long and short stuff, because if people see some of those positions, like market makers will wreck you. It could have all the momentum in the world. We're seeing 68. Let's say tomorrow it's back over 70 and it's pushing to all-time highs and everything looks great. Longs are going to go in, right? People are going to put positions, and this is right into the explanation of it. This is when you believe the price of an asset will go up. So you buy it expecting to sell it later for more money. That's a long position. On the short position, this is when you believe the price of an asset will go down. So you borrow and then you sell it, borrow it and sell it now, planning to buy it back later at a price after the price has dropped. So you're creating a margin situation here where you're so sure that it's going to collapse, and you're creating this on margin. Now you can get margin called. There's a lot of other risk and nuance with that, but think of those like mechanical aspects in their own. The more step back view of all of that is just because those are mechanical things that can happen, either long or short. Everybody looking at enough people doing either or position will play like 4D chess on you and create a situation where even though the momentum, it makes absolute sense. There's, let's say the government comes out and says, hey, the Treasury is going to accept it as a currency in the United States, largest liquidity pool in the world. From a capital standpoint, China is not far behind, but like, let's say both overnight say, hey, we're going to include this as Treasury. It is part of the world. Everybody's going to go long on that. But then market makers are going to be like, haha, let's see how outweighed the long positions are. And then they're going to short the crap out of it, and you're going to get wrecked, and you're going to get your margin calls. So I would just say on those long and short positions, just really do your research on that, what exchange you're using for it. There's been a lot of market manipulation in these exchanges. There's a lot of incentive to wreck people on it. So just be very careful when you're doing that stuff. The analogy on the short position, I'll give you that. Imagine you're borrowing your friend's bike and sell it for $100. You plan to buy the bike back next month thinking that the price will drop to 50. If you're right, you buy the bike back for 50 and then give it back to your friend and keep the $50 difference. That's short selling. It's something you don't own, but you're expecting the price to fall, and then you're getting it back. So that's a quick analogy on it. Like, now don't do that to your friends. That's probably not a good thing. But that's exactly what that is. You're borrowing to sell to then buy back, and then you got to close that position with giving back what you took, right? And hopefully make money in the process, right? But you're still on the hook. So that gives you kind of an understanding on how the short position. I'm sorry for any of you trader bros out here listening to this, and it's probably like, but not everybody has that knowledge with you guys. So you're kind of like in the circle of friends here on all the viewers, 134 on it looks like YouTube. Just we're trying to help, and any comments that you can add in here to help clarify or increase the knowledge here is great and appreciated, my dudes, when you're sharing with that. So a quick summary of what we just covered. Makers set the price and are willing to accept it and wait for somebody to accept it, like a lemonade vendor. Takers accept the current price that's already set, like a thirsty customer. Slippage is when you think you're paying or receiving something at a price, but you end up with a slightly different price, like a changing bid in an auction. Long means you're betting the price will rise and you're buying like apples cheaper to sell them later for a higher price. Short means that you're betting that the price will fall, like you're selling a friend's bike now to buy it back later for less and then hand that bike back to a friend. So that's a quick summary. I'm trying to keep it dense and lean for you guys, for you can share to friends and share this content. And then probably one of the most important things I look at in this space is market depth, because market depth can move. You can have a lot of day traders out there putting positions in, removing positions. So it's a very, very fluid, what I would call a just-in-time event, right? It's a just-in-time event. So like, you could look at something today and see there's a ton of volume. There's a ton of trades. There's not much slippage potential of the existing standing orders right then and there. And then tomorrow it'd be a completely different market, right? They could get super lean in depth because people pull those bids or those options because they don't want to sleep on it. They don't want to get into a situation where you're like, you know what, Bitcoin's at 68. I'm going to put a buy order in at 60. And then overnight it flash crashes to 55. And you're like, crap, I could have bought it at 55. So people will pull orders sometimes. They won't sleep on it, right? Or they'll pull their order and lower it because they're like, maybe market does reach down a little further when I'm sleeping, because Bitcoin and crypto, this market is a 24/7, 365 market. And there are people all around this planet doing it. So, and then each of those exchanges have an ebb and flow of synchronicity because of the arbitrage situation, where you'll have people have accounts across all these exchanges, and then the bots keep all the arbitrage in order. Like there was a period of time back in the BTCE days, and I know I'm dating myself for folks out there, that's one of the largest exchanges around the Mt. Gox time too, that was out of Greece. You would have sometimes massive discrepancy between BTCE and Mt. Gox. And when Poloniex came online and Cryptsy, Big Vern took our money, my dudes. You had all these different companies out there, or exchanges out there, and there was just huge arbitrage opportunities between these because there wasn't a lot of synchronicity between, either bots or APIs that would come off chain out of your wallet into their exchange in a wallet. You had all that timing aspect to try to arbitrage the difference if you had a massive change. Now the market is pretty mature from a linkage of these systems together for you to really have B2B relationships on some of the larger market makers to kind of keep everything in order. So if you do have somebody at a Korean exchange dump a price, you're going to see it auto adjust itself pretty quickly across the market. You're not going to have a huge market slip between the two different types of exchanges around the world because everybody's going to take advantage of that arbitrage. So it's a much more mature market now when it comes to those aspects. So there was a time and a place where there was massive opportunities of arbitrage back then. If you were a young developer learning how to do API stuff and just set that kind of stuff up. Mass boost. Big Vern and did take my money. We lost quite a bit of Litecoin. Most of my Litecoin that I had mined through 2013 through roughly 2015 was on that exchange when it went under down there. It was just an exchange supposedly out of Florida, and it was just one day it was gone. And it's like, and it's gone. And some of my Feathercoin too, unfortunately. I learned some pretty hard lessons of not keeping huge amounts of liquidity on exchanges at the time. And it was a whole not your keys, not your coins stuff from back in the day too. But it was at the time, if you were trying to pay for your power or you were trying to provide, get some liquidity, you had your money in the exchange. That's where it was at. There wasn't a ton of decentralized exchanges. Really didn't come around until really Ethereum at any kind of scale, mainly because of the scripting languages in a lot of the layer one, UTXO based coins, which is unspent transaction outputs. That's the framework that Bitcoin's scripting languages, follow within. It's like CAD, digital cash. When you are coming out of your wallet with your Bitcoin, like let's say you had $20 in Bitcoin and you're trying to send $5 to somebody, it broadcasts the whole $20. It's just like you're handing $20 at a store to somebody, and then you're paying for whatever you're doing. That's going to the recipient, and then you're getting the change back to you. So that's what that UTXO architecture is from like Bitcoin, is you're sending all the money out, and then you're getting back your change back to your wallet under, a transaction set. So then you can keep traceability of how everything went. Like it went out, it came back in, that's your change. Your other coin goes to somebody else. So it was a very simple scripting language that is built into Bitcoin. So like trying to create these like third party activities to create any kind of movement of Bitcoin in that. That's why like you have like Bitcoin and a lot of the UTXO coins that are on decentralized exchanges are under the capacity of a wrapped coin. So they are creating an instance of those wrapped coins an instance of those coins. So they're locking them up using a time lock on Bitcoin that they control. You send the money over to that exchange. They have it on the Bitcoin network, and then they make a representative example on that decentralized exchange under like WBTC. So it's a one-to-one relationship. So now you can leverage your Bitcoin, quote unquote, your replicated value of that on another network. And then you can start to do some of the innate behaviors that you can create with like an Ethereum environment or a Solana environment or a Tron environment, anything that has advanced features on it on the blockchain side that you can create decentralized exchanges. And then you have all that stuff that stuff really didn't start to show up until about 2015. September of 2015 is when you could start getting into mining Ethereum and stuff. But that brought a new behavior of opportunity when it came to cryptocurrency in general. A mass boost, yeah. It has several Litecoins in there too. Yeah, I'm telling you, my dude. So again, very quick video. I didn't really use the whiteboard much on this one. I did have it there just in case if we wanted to break into it. But I mean, you guys tell me a quick before I wrap this one up. Do you guys like this kind of content? Is it too rudimentary, too basic, or is this kind of stuff needed? I mean, this really isn't maybe for the intended audience of you guys, if you guys are into crypto very much. But I know all of you guys, all of us, everybody in this chat that are watching this have friends, have family that are in it tangentially in some way. And sometimes content like this allows you guys to be able to share this to them and say, hey, I could explain it to you, or you could watch this video. Watch it at about 2.5 times speed, and that way you can get through it pretty quick. But yeah, let me know in the comments if you guys think that this kind of content's good. If you want the deep dive on the layer 2 aspects, and we can do a live stream on that. And I'll peel it back. And that one I might have to use the board a little more because there's way more nuance on how the mechanics work with that on like the smart contract side of it. So it might get a little bit on the dev side, the development side. But yeah, if you guys think this is good content, let me know. And we'll continue this series. Again, we're live next week, also Friday. We'll put that out. If you're following us on Twitter, make sure you're doing that, or X. We're trying to do the announcements across all the major socials when we're doing it and what the subject is. And then, yeah, we'll, and maybe one day we'll bring in like, have audience or somebody that you guys want us to talk to. We can always do a live, a session with somebody or a company. Just hit us up, let us know. I'm happy to start to, turn this into kind of podcast style if we want to see that. But just trying to bring you guys some stuff. I could listen to you read me a bedtime story, BBT. Well, thanks, Two Bros Mining. Love it. Just try to bring some content. I'm gonna go through some of these comments here before we wrap it up. So, Zip Pirates said, BBT enjoyed the video where you talked to the local city council. We need more stuff like that. No problem. We're actually going to be, we're doing 2 builds here locally, 2 5 megawatt locations. One looks like it's going to be some building or a building. So we'll go through that whole step, which will have another city council and county discussion. I will bring that camera if I can there and just let you guys see that perspective. Next week also, we're going to be doing safety training with some of our employees out at an electrical substation, and the local power company is going to be providing that. I've already asked them if I can use video there. They don't care. They think it would be fine. So if you guys like that kind of content, we'll put that out there too. That might be more of a produced video, but we're going to walk through we're going through like an NEC training session to understand what, from a safety standpoint, when you're on an actual substation, when you start talking ground grid, phasing, if something's out of phase, if a line gets dropped, that kind of stuff. So, good content to understand from a, high load factor power aspect. So we're going to be doing that, bringing that some content for you guys related to that. And then we're working on some partnership stuff with a couple different brands and maybe doing some partnership stuff and some sponsored content. But the way I like to do stuff, guys, I like to break it apart and see what works, what doesn't, what could be fixed. So you might see some new content related to that. But yeah, try to just get some knowledge out there, share some of the experiences that we're doing with you guys. And again, we got a newsletter out on the page on BitsBeTrippin.io. We got some fresh swag. I was actually going to wear it and I forgot. I know Danielle's probably watching this like, why am I not wearing my fresh swag, my dudes? We got some crypto tales from the crypto swag out there. We're going to be putting some more stuff out there for Christmas and stuff. And we try to keep it reasonably priced. I mean, I think that's like $30 for a hoodie, maybe 35. But like, it's not super expensive stuff. So try to keep it, out there to get the brand out there. All right, my dudes, it's been real fun. And we will take, you guys to the next one next week. I'll see you guys next week, noon on Friday.